feel bad if you tell me that whatever I'm saying is stupid or doesn't make much sense. It's the first time, so that's what happens. Okay, so let's get this going. So let me start by talking a little bit about the informational role of prices. So if we all think about it, one of the most important characteristics of markets in general, not even financial ones, is the fact that prices usually incorporate information that investors have about its fundamental value. And there's a huge literature in economics and in finance that tries to understand a little bit how investors acquire information to become informed and how they trade it. So if we think about the Grossman and Stiglitz paper in the 80s, Admati, Diamond, Verrecchia, the literature has started making more and more complicated models that try to explain why people trade so much, how do they exploit any particular informational advantage that they may have. And if you think about the basic models that we all learn in microeconomics, I mean, often there is actually no trade, right? I mean, we may be given a certain allocation, we optimize, and that's it. So the way that people have modeled how and why investors trade have used a wide array of strategies. We have models that are based on agents having differences of opinion. So we might believe different things about the same asset. We have situations in which we can have some agents with different investment opportunity sets relative to others. So for example, some investors can invest abroad while some others can only be domestic. Sometimes it's due to the fact that some investors acquire private information on their own. So we can think about mutual fund managers spending money to try to acquire some informational advantage. Sometimes this depends on the informational technology, so how we process information. So we might observe and read, say, the same announcement by the Central Bank of Brazil, but some people might have different ways to process this than others, okay? And if we carry on a little bit more, we also have hundreds of thousands of papers that show that some types of investors, so institutions, hedge funds, private equity managers, that they have some superior ability to deliver abnormal So, and in particular, I mean, we also have strategies. So if we think about momentum, even, well, butcher market that used to work and doesn't work anymore, we also have lots and lots of ways to portfolios that deliver alpha. Okay, and in particular, and that's kind of the main area that my research focuses on, there are lots and lots of papers that show that short sellers can forecast future returns. So for those of you that have never heard about short selling, it's something that is actually quite old. The first one was recorded almost 400 years ago in the Netherlands. So we had this Dutch guy called Isaac Lemaire that he was actually shorting tulips. And last time I was getting some data on this. I mean, if you go to the New York Stock Exchange website, they have a daily file that tells us how many shares had a short seller at any point in time, okay? And just to give you an idea about it, 42% of the trading volume in the New York Stock Exchange these days involves a short seller. So this can be a high frequency trader, opening and closing on the same day, or more long-term ones. And the definition from the SEC is that a short sale is the sale of a security that the seller does not own. And in order to deliver the security to the buyer, the short seller has to borrow the security, typically from a broker-dealer or an institutional investor. So remember then that if, for example, I'm trying to sell a share of Petrobras to Alan and I don't have it, the idea is that we're going to borrow this share from another investor that might not need this share and deliver it to Alan. And the name that we give to this market is the securities lending market. And that's essentially, that's the market that involves borrowing shares in exchange for a fee. Okay, so this next slide here shows essentially how securities lending work. You can see that on the right, you have your borrower. So that's typically going to be, say, a hedge fund or an investor that wants to bet that the price of a company is going to go down. okay? And if this investor shorts, he needs to get the security, okay, and deliver it to the buyer. But where is this security coming from? Well, there's usually a middleman or middlewoman who is the lending agent. So this can be a big custodian or sometimes even the broker dealer. And the lending agent finds these securities from someone else. And that's our lender that's here on the left-hand side. And soon I'm going to tell exactly who those lenders typically are. So in exchange for giving these securities to the borrower, the lender will get a fee and also some collateral that will protect the lender for the situation that the borrower cannot give back the securities that were borrowed in the first place. Okay, so essentially that's how then it works. The borrower will leave a collateral with the lender, will pay a fee for the loan, like a rent. The lender is still entitled to receive the dividends. But when we lend a share to the borrower, we also lose voting rights. And I have a paper that looks a little bit about what is the impact of losing these voting rights. But just to give you an idea about how big this market is. So ISLA, which is the International Securities Lending Association, they reported at the end of 2018 that we had about 2.2 trillion euros in outstanding loans. So that includes both equities and bonds. And annually, this generates about 9 billion euros in fees to the lenders, okay? Which again, is not pocket money. That just shows how big this market actually is, okay? And who are the main lenders out there? So you can see here in purple that 48% of the lenders tend to be mutual and retail funds. And that includes active funds, passive funds, and ETFs. Okay. We also have 20% coming from pension plans. So those typically are what? Long-term investors that they're not going to be buying and selling shares every day. And a way that these lenders can generate a little bit more income is by essentially lending this to the short sellers. Okay. We can see that 16%, well, is undisclosed, but we have some that is also coming from sovereign entities like sovereign wealth funds, from central banks, and so on. But the main feature of this slide here is that about 50% of all the amount that is lent out involves a mutual fund or an exchange traded fund. Okay. And so if you remember, I started by saying that the short sellers tend actually to be good. So they have skill in generating money. So this is a graph here from this Boomer et al. Paper from 2010 in the JFE that essentially looks at what happens to a portfolio that involves and shorting stocks that right now are being highly shorted by the market as a whole. So every month we can observe and have an idea about how much short selling takes place. So if you take a look here at the blue line, we can see that if we short today stocks that are on the top 1%, over the next 6 months, we can see that the cumulative alpha using the FOMA French four-factor model is about 6% a year. Okay, so usually stocks that are being highly shorted today, they can forecast negative returns in the future. The red line also shows that the absence of short selling reveals information. So if we take a look at the red line here, we can see that stocks that are not shorted by the market actually tend to outperform. So if you take a look at the difference between the red and the blue lines, that comes at about 9% after 6 months, which explains this long short alpha from short sellers of about 18% a year. Okay, and that's another number for you to keep during the presentation. Simply that the literature has shown throughout lots and lots of papers that the short sellers can somehow forecast future underperformance. Okay, so we have papers that look at this not only from the equity point of view, but also from bonds using microstructure, and everyone tries to understand a little bit more who are the short sellers? I mean, are they retail investors, institutional investors? What are the types of stocks that they short? And essentially how they come about this, okay? And the literature has considered and has shown three different ways in which short sellers make money. One is that they uncover private information. So for example, there's this paper by Karpov and Liu that essentially that they show that short sellers start shorting a company about 1.5 years before the SEC starts investigating a company for accounting fraud. Okay, so essentially they are doing their detective work and they uncover problems with accounting and so on, which is related to this idea then that they find negative information and they embed and they incorporate this information into prices by trading. Okay. There's another paper by Engelberg et al. That they also show that part of the disadvantage comes from better processing of public information. So they focus a lot on what happens around earnings announcements. And they essentially show that short sellers are able to act faster to the announcements that are made by companies than most in the market. There are a couple of papers also that say that the alpha that we find for short sellers actually just comes as a simple compensation for providing liquidity to the market or for risk. So there's this paper by Carl Dieter in 2009, and this one in 2019 is actually one that I wrote myself, in which we show that part of these returns essentially come for the risk that short sellers face. And overall, I mean, the idea here then is just to try to convince you that short selling is an important channel that reveals negative information about companies. And what we're trying to do in this paper is essentially to look at these three questions that you have here at the end. So do we see other investors changing their behavior when they observe shorting demand? So for example, if Alan sees me shorting, does he change his portfolio? Okay. Is there a difference between investors that are actually lending shares in this securities lending market relative to those that don't? So that's the second bullet point. So do we observe any advantage by lending shares to react to this information? And three, another question is how prices actually move. Is it just the short sellers selling, or is it just regular sellers that own the stock that also start exiting the shares? So in a way, I mean, we start seeing whether the actions of the equity lenders they complement or they supplement whatever the short sellers are doing. Okay, and in very broad terms, those are kind of the three main questions that we're trying to do. But let me formalize then this to you and show us what are our four main hypotheses that we're going to test in the results that I'm going to show you. So the first one is that funds that lend a stock, they decrease their holdings after an increase in shorting demand. Okay, so the idea here is that if I observe an increase in the short selling activity, myself as a mutual fund, I'm going to reduce my position in those stocks. Okay, and in particular, if I am a fund that is lending this stock in the security lending market, I'm going to do even more so. Okay, so the idea is that there is some private information that just participating in the securities lending activity will bring to the table and make me change my portfolio. Okay, our second hypothesis is that not only we're going to change our holdings, we're actually going to do this relatively faster than those that don't lend it. So hypotheses 1 and 2 are about quantities. So if we look at the portfolios of mutual funds, let's see whether they change the way they decide to buy or sell stocks. And 2, whether they manage to do this faster or not relative to those funds that don't lend and have a little bit then less information about the dynamics of short selling activity for a particular stock at a certain point in time. So hypothesis 3 moves then from quantities to returns. We actually show that security lending makes funds trade more aggressively on negative news. We actually test whether, or our hypothesis is that exits by funds that are lending a stock can predict future negative returns. So after I get out of the stock, I predict that this company will keep falling relative to the exits to funds that don't lend. So the idea here is that being a participant in the securities lending market allows funds to leave losses on the table. So essentially, I mean, we just prevent losing even more money when we lend shares and exit a stock than if we weren't lending. Okay, and all of this is then consistent with this complementarity story that this paper by Itay Goldstein and Young have in 2015. And in a way, I mean, we're trying to see understand, well, who is doing this work following short selling activity, and whether this whole securities lending market is useful for something from an informational point of view. Was there a question or?
Yes.
Yeah. Okay, so are you gonna give us some more information about what is observable, who sees what in terms of public and private information about short selling activity?
Yes. So when I start talking about the data sets, I promise that I'll go back to that, and let me know if you're still not happy with it, okay? So the fourth hypothesis is that at some point I'm going to, of course, talk about endogeneity and trying to filter how much information is coming from this equity lending market and how much is coming from just public information, which I guess is exactly your question. And so when we're going to use this EU regulation that looks at the disclosures of short selling, and we actually find that securities lending allows active funds that lend to essentially front run these public disclosures. So essentially they start getting out of their positions even before we have a disclosure to the market that there is a big short taking place. Okay, but I promise that this will become clear when I talk more about the data and so on. So before I move on and start talking about then the data sets and the actual results, let me just summarize what we're trying to do here. So essentially, securities lending is a mechanism for acquiring information. And in the paper, we try to bring this new channel through which this information is incorporated into prices. Okay? And that comes from the fact that active mutual funds, they're going to use this securities lending information to change their portfolio holdings. Okay? And this also brings in then information to the market. And because when in our sample, we have not only active mutual funds, but also passive ones, this actually provides us with a very nice placebo test. I mean, because of the constraints on passive funds, they're simply just tracking a portfolio. If our story that this information is being used by investors is correct, we should not observe any major effects for passive investors, because we know that they have their arms tied behind their backs and they cannot really trade on any new information, but observe this to the active funds. And that's exactly what happens, okay? We also see that for highly shorted stocks, active lenders have relatively lower losses. So that was the avoiding losses in the table that I talked about you. But when we try then to understand that whether even though they avoid losing money, when we try to see whether they are able to have a better fund performance overall, we don't find any big changes in the performance of one fund relative to the other. And that's simply because most funds are not going to be owners of shares that are highly shorted by the market anyway, okay? So when we start talking about then identification and so on, as I mentioned, we use this disclosure of large short positions that the EU implemented from 2012 onwards. And we do find that the active lenders, they start getting out of a particular stock relatively quicker than those that don't lend. And they seem to essentially be bringing to the table the same information that the large short sellers do when they report this to the markets, okay? And essentially, short sellers and the security lenders, they have a complementary role, and they kind of all trade in the same direction rather than against the others. So now let me talk a little bit then about the data. So the main advantage of having one of my co-authors working in the German central bank is that he's the one that really got this amazing data on the securities lending activity of German mutual funds. Okay, so every single month, mutual funds in Germany have to report to their regulator. So just like CVM here in Brazil, every month they have to report how much they have been lending for each stock in their portfolio, for each security, okay? So in our paper, even though we have bond funds and equity funds, we focus just on equity that have more than $10 million in assets under management with at least 3 years. But that's really one of the main contributions of our papers. We are the first paper in the world to actually have data inside the portfolio of a fund that allow us to see what are the motivations behind choosing to lend or not a particular stock. So in the US, even today, and I think it only started 2 years ago, all that funds have to report is whether they lend or not. So we don't have this, level of detail in the data. And essentially that's what allows us to do everything in the paper. Okay, so essentially for every stock, for every fund, in every month, we have an idea whether that fund is lending the stock or not. Okay, the next data set, and that's the one that I've used the most on my research, is to look at the aggregate short selling activity. So is this data set by market that tells us every day for every single stock you can think of in the world, how many shares are being lent for, in this equity lending market, which is a proxy for how much short selling we have. And in Germany, we have an average of about 2.5% of market cap being shorted at a certain month. And it's generally actually very cheap to short. I mean, the typical fee in Germany is around 0.84% a year. Okay, of course, there is lots of cross-section on time series variation in that, but it's just to give you an idea about the aggregate short selling data that we have.
Pedro,
oh yes, I think Pedro, I had a question from Andre.
Yes, I have a question. It's Bonomo here. I want to do the question at the end of your introduction, but now that I'm able to, you have just to understand, because I could think that there are two kinds of investors. For example, investors that usually lend securities and short sell, and investors that don't do anything as the mutual funds. And you are talking about this information. For example, if I am lending a share, but I'm not lending specifically the share that was heavily shorted that give me a signal, or you are only talking about the guy who is lending the share that is actively very shorted.
Okay, so what we look at all of those.
When you do the comparison, because I could think that all guys that lend securities are well informed, and then all of them have an advantage with respect to mutual funds. That's my.
We're going to look at all of this. So essentially, we can have a fund that say they can invest in Petrobras. Some funds might decide to lend Petrobras. Some others might decide not to lend Petrobras, right? And essentially to allow short sellers to do their thing. But because we have such variation in our data, so we not only we have data for, say, Petrobras, but also for Vale, we can also look at whether a particular fund chooses to lend Vale rather than Petrobras. We can control for the amount of aggregate short selling, which I think is the second part of your argument. Okay, and then I mean, since we have this level of detail, we can essentially really use one of those saturated fixed effect models and control for fund time fixed effects, stock time fixed effects, control for whether a fund is active or passive, kind of like trying to remove all of this, all of the unobserved characteristics that might affect, and really focus on whether we can identify a difference simply because you choose to lend a particular stock in your portfolio or not. Okay, and that's pretty much what we're trying to do. Does that make sense to you?
Okay, then is the guy who is, if there is an active short in Petrobras, only the guys who were lending Petrobras are the ones that get the information.
Exactly. Okay, because, and I think like, if we think from your question, yes. So at any point in time, I mean, any of us, we can have an idea about the aggregate level of short selling of Petrobras, okay? Because this data is reported and so on. What we're trying to look at in the paper is, because if you are lending Petrobras to someone, this might allow you to see some information or some variation in demand faster than everyone else. Okay, and that's what we try to measure to see if this has an impact on or not. Okay.
Okay.
So going back then to the data, we have then the mutual fund, the holdings and securities lending from this German central bank. We have aggregate data from market. We use this European Union regulation. So since 2012, any investor shorting more than 0.5% of market cap has to report this to the market on the following day. Okay. So essentially, I mean, we have the name of the big short, of the large short seller, the name of the stock, how big his position is, and the position date that we observe. So during our sample size from our sample period from 2014 to December 2018, we have almost 130,000 large short disclosures. So here, I mean, this can be either, I don't know, one of the funds by one of the long short funds of AQR, so that they have to report their big shorts. It can be an activist, a hedge fund that actually is shorting a stock. We have all of those in there, okay? And this is something that will allow us to do our identification strategy to try to disentangle then the difference between something that the whole market knows from private information. We also use Morningstar to get data on German active and passive mutual fund returns and characteristics. So fund flows, assets under management, the typical mutual fund characteristics. And finally, our stock returns, they come from data stream. So, and we look at stocks across these 23 developed markets in the Fama French 2012 papers, okay? And why that happens? So this here is just a descriptive statistics of the sample of funds that we have, okay? So in total, we have about 314 funds with about, and they manage about 7.2 billion euros, sorry, yeah, I think, yeah, 7.2 billion euros in total. No, actually, sorry, guys. It's 7.2 trillion euros in total. It's a big number. Notice that out of this 314, we have about 15% that they are German focused only. We have about 30% that they focus in Europe. We have about 87 that have a global exposure. Okay, so out of these 314 funds, we have that about 80% of them are actively managed. And the remaining are passive, so like an index fund. If we look at the proportion of those funds that lend, notice that there is quite a big difference between the proportion of passive that decides to lend relative to active. So about 70% of passive funds engage in securities lending, exactly because they don't care, right? They're just following the benchmark. So one of the ways in which passive funds cover their costs and generate money is by what? Through securities lending. It's a way for them to generate a little bit more alpha. Yes?
Pedro, yeah, so a question from the audience here. So one is, so the key, the theme is about the delays in the release of the regulatory filing. So what do market participants see? How long after the that's filed and so on?
So I'll give more details later, but essentially what happens is, if I'm a short seller and I short a large amount, such that it's above this 0.5% threshold, the market finds out immediately on the next day. Okay, so that's the disclosure rule. So they started this back in 2012 around the Greek crisis, because the European Union was afraid that the short sellers were actually driving down the bond prices of Greece and manipulating the markets and making the whole crisis worse than it was. Okay, and essentially, I mean, what I'll show you when I do these experiments is you see, okay, in the same way that the big short sellers might know something and short, and then they communicate to the market and everyone knows, the security lenders might actually observe that there is a big increase in the demand to borrow shares to short, and we see whether they actually start getting out of the share and using this information about potentially negative information of a company in the future to get out. Okay, and that's essentially what we try to do. But I promise that in about 4 or 5 slides, I'll show you the results when we try to do that. Okay, but from this table then, I want you to remember, we're using data for about 314 funds. So we have this over 5 years times 12 months for these 300 funds. And on top of this, we have the information for every single stock in their portfolio. Okay, so funds tend to lend about 55%, about 3.4% of their total assets under management is lent out. So as you can see, it's not a big amount, which might explain why we don't find such a big effect on the total alpha of the fund. Okay, and even when they lend, they often don't lend the whole amount that they have in their portfolio. So this number here is kind of saying that, well, if I have 100,000 reais in Petrobras, the typical fund, if the fund lends Petrobras, we only lend 55,000. Okay. As you can see, this can also have large variation. Okay. So how then we test this whole thing? So the first set of results that I'm going to show you essentially looks at the quantity variables. So our main dependent variables are to first, let's look at the change in position for a given stock in a given fund relative to the last month. So if this is positive, that meant that I have increased my position in Petrobras by 10% or reduced this by 10%. Okay. And notice that if funds react to all of the securities lending story that I'm trying to tell you, if they reduce their positions, they might reduce their positions completely. So they can just sell everything that they own in Petrobras and that's it. Or they can just what? They can just sell a little bit of Petrobras. So not only we look at the whole set of position changes, but in the second bullet point, we also concentrate on reducing the position, but not by 100%. Okay, kind of trying to understand whether when funds react to short sell information, do they react completely, get out of Petrobras, or just a little bit? We also run some specifications, just creating a quick dummy that is equal to 1 if the fund has sold all of the shares of a given firm. Okay, again, my example of getting out of Petrobras. So what is the typical regression that we run here? Okay, so if you start, let me start by...
Pedro, if it's a possibility, would not be the fund to become a short seller of Petrobras themselves?
So, in theory, yes. I mean, I think in Germany, just like in the US, quite a few funds, they're actually by their, well, they cannot short sell by their own constraints, okay? Unfortunately, just like in the US, we don't observe the short position of mutual funds. So when we see that they get out, we have no idea whether they're getting out and shorting the stock, which I agree with you. I mean, it will be something interesting to even see, okay, if they really believe in this information so much that they're willing to sell Petrobras, they might actually go short and try to make money. Totally agree with you. We would love to do that, but unfortunately, we don't have the data, okay? So essentially, I mean, here in this regression, we throw fixed effects at all these levels that you can think of. So stock time, fund time. So we are controlling for stock characteristics in a way. We're controlling for differences across funds in a way. We also have stock time active fixed effects. So maybe there's a difference in which passive and active funds choose to react to information. And essentially the key coefficient that we're trying to study here is this triple one, so the beta one. Essentially, we're trying to test if active funds that have lent this stock in the previous month react more to shorting demand, which is this on low one, okay? So typically, we know that the more we short, I showed you that result that stocks tend to underperform. So we're trying to see whether the reaction to these changes in shorting demand vary with securities lending activity. And also if there's a difference between actively managed funds and passive funds, okay? And that's where that nice placebo test that I talked to you about before comes into play, okay? So let me show you then the big regression. So here in columns 1, 2, and 3, we're looking at the position changes, okay? So notice, for example, in column 1, essentially, we're showing that active funds, okay, so actively managed funds, they tend to reduce their positions if they lend much more than those that don't, okay? In column 2, we bring in some interactions, okay? So notice that for an active fund, this dummy will be equal to 1. And we can see that the sum of these effects, so the minus 0.64 plus 0.16 is still negative. So that's essentially telling us what? Well, if I am an active fund that has lent the stock last month, I am going to reduce my positions a lot more as we start observing this short selling demand. Okay, so this is robust to all those fixed effects. In column 3, you also try to control for illiquidity, previous weight in our portfolio, and so on. But the results are still there. Okay, and that's the test for the first hypothesis that I talked to you. It does seem that investors tend to react more to changes in short selling demand if they are securities lenders. So that's the second row. And even more so, so they react even faster if they are lending and they are unactively managed funds.
Is it possible to understand what is the economic impact of that? Like, what is the...
Yeah, so I'll show, again, I'll show you, I think, in the next slide, exactly what's going on in terms of returns, right? Totally agree. At the end of the day, I mean, if they change their positions without really changing their returns, it's not as interesting for us as economists, financial economists, and so on to understand what's going on. Okay, so but this first slide is just to say that lending seems to make you more reactive to changes in short selling demand. Okay, so these results don't really come. If we look at position changes without the exits, the results are still there. Column 7, 8, and 9 use this dummy. So here the signs should flip, right? I mean, if I observe an increase in the short selling demand, it's more likely that I'm going to get out of the stock completely. And in the next slide, we just split this between whether you are an active fund in panel A and a passive fund in panel B. And that's kind of the placebo test that I was showing you before. So notice that while the active funds reduce their position as we increase shorting demand, notice that the passive funds actually increase it, okay? Which is kind of what we would expect as we see all these active funds dumping shares and someone has to buy them. And it seems that the passive funds are the ones that do it, okay? So now, I mean, we can finally talk about the returns, which I think is what Rui was asking for. So in table 7 of the paper, what we do is we look at the stocks that are being highly shorted by the market. So those in which there is more negative private information, at least in expected terms, okay? And then we take a look at all of the position closures of those German mutual funds. So we look every time a German mutual fund completely exited a stock, okay? And then we split this in between stocks that were being lent in this securities lending market to those that have not been lent, okay? And what we're trying to do here, so this table is a little bit, I guess, different than the way we usually present this. Essentially, we're looking at cumulative returns such that at time 0, so kind of where the dashed line is, the cumulative return is 0. So if you start looking at t minus 12 and you see that the alpha here is equal to 8.8%, notice that in the 12 months before a fund decides to sell a stock and get out of it that we were lending, the returns of this stock went down by almost 8.8%. So it's just showing that the returns of this stock, they were probably going down over the last 12 months until we finally decide to sell it, okay? Afterwards, notice that after we get out of this stock, notice that the returns, they keep going down, okay? So from this point of view, notice that this is actually good, right? It's a smart way to look at what these funds are doing. So after they sell the stock, it keeps going down. So that's what we mean by avoiding losses on the table. The next column that I'm going to show you looks at those funds that exited the stock, but were not lending it to begin with. So notice that we observe here that those stocks also were underperforming before we got out. Okay, so, and they were performing by even more. So the stock goes down by about 14.5% before that we decide to get out. But notice that afterwards, nothing changes. This thing here is stable. So when we compute this difference in performance between funds that decide to lend relative to those that were not lending, notice that lending allows funds to reduce the losses that they would face, okay? So this here then goes back to Rui's question and what I was saying about having an impact on the returns. So essentially, by lending shares and participating in the securities lending market, it seems that funds prevent losing almost 7% relative to if we didn't lend, where these results are pretty much close to zero and not statistically significant. Okay, so again, this here is just looking at the stocks in the portfolios that are the most highly shorted. I think we're using the top quintile. And then we're just looking at what the funds do when they get out of this. So notice that here, I mean, we're really putting together a bunch of things, right? We don't know why they're actually getting out of this stock, whether it's because of public information, whether it's because of something from securities lending, and that's kind of the whole joint determination process that brings in the endogeneity problems to our case, okay? So if we take a look at this at a more structured way in a regression framework, we find the same results. So if we look at the cumulative 6-month alpha after we get out of the position, we see that the higher on low one is, the more negative the alpha is if we lend. Okay, so this would be this first column here in a regression framework. Okay, if we look at the cumulative 1-year alpha, same thing happens. So there does seem to have some return implications if we choose to be a lender of our shares or not. Okay, so now I can finally move to the final bit of the paper and talk a little bit then about our identification. So remember that our main motivation to do all of this is to try to understand what is the information that securities lending markets bring to the table, if anything at all. But it's really difficult to disentangle something that is private to the funds that lend relative to just the public information that all of us can identify about the short selling activity of a particular stock. And that's when this European regulation help us, okay? In a way, I mean, this is a big disclosure of short positions, okay? That we know from previous works, from actually one of my co-authors, that this disclosure is actually informative about future returns. So they show that a strategy that shorts these stocks right after the announcement is a strategy that generates alpha of about 7% a year. Okay? So what we try to do here is to see, okay, do our active funds that lend react differently before this disclosure happens relative to those funds that choose not to lend? So are they also smart to know that there is something wrong with that stock? And even though they might not be short selling, they're actually getting out of their positions, yes or no? So in a way, I mean, we kind of repeat the analysis that I showed you in the previous tables, but now rather than looking at just any exit, we just look at what funds are doing in the 6-month window around these disclosures. And we interact them with a dummy equal to 1 if a new large short position is disclosed in month T for a particular stock, okay? And just to avoid showing you the regressions, let me just try to show this in a graph, okay? So in dark, we have the cumulative difference in terms of the position changes between funds that decide to lend and not lend. So notice that we do start observing the funds that lend reducing their positions prior to this disclosure. So that's kind of like the significant stars here in -3 and -1. That means that, say, at T-1, funds that lend reduce their positions almost 4% more than those that didn't. Notice that after the information becomes public, none of this is significant. And that's what allows us to say that it seems that there is something about lending that allows the active funds that choose to lend to also anticipate the large short trades from when they are disclosed. And they also then seem to be front running the short sellers. And that's kind of this complementarity result that I was talking about before. It seems that both funds that lend and the short sellers find something bad about the particular stock, and then they start trading upon this. So it's not that the active funds are just reacting to the announcement, it does seem that they are actually shorting even before the market knows about it. And maybe the way they are actually finding out about this is because they have slightly better access to the dynamics of the securities lending market because they choose to lend. So they might pay more attention to what's going on with securities lending. They might actually see at how much of their holdings in a particular company is being demanded by the market. And then they realize that there's something dodgy going on with it, okay? And that's kind of what's happening. So this here is the big regression version of all of this, okay? So we are interacting the disclosure dummies with whether we lend the securities or not, and our proxy for short selling demand, which is equal to unknown. And essentially we find out that, for example, if there is a disclosure at T+1, so next month, notice that today our position change is negative, okay? Which is then consistent with this front-running result. So I'm conscious that my time, I'm actually 4 minutes behind schedule. So let me shut up here and then we can talk more about any questions that you have. So this is just the same summary that I gave to you before. In this paper, we show that securities lending is a mechanism for acquiring information. And it is a new channel through which the information that the short sellers that are borrowing the shares bring to the market is actually incorporated into stock prices. So the funds that decide to sell, reacting to a change in short selling demand, are essentially trading in the same direction that the short sellers have in the first place. So they actively change their portfolio holdings, okay? So they seem to do this much more quickly than those that choose to not lend at all. When we look at passive funds, they don't have this behavior as well, which is kind of a nice placebo test for us. Simply because passive funds, they really don't care about the ups and downs of the market. They just track the benchmark, but the active ones, they do. Okay, this here seems to have some impacts on the returns of the highly shorted stocks. So it does seem that if I am a fund that own a company that is hated by the market and has lots of short selling demand, being an active lender allows me to reduce my losses when I decide to sell my position. Okay, when we run the regression, and I didn't show you this today, when we then try to look at an estimate of whether the alpha of funds that lend shares is different than the alpha of funds that decide to never lend, we cannot find anything. Okay, so, and this happens that even though we find the significant results for the highly shorted stocks, the proportion of a portfolio that a German mutual fund owns that is invested in those highly shorted stocks that the market hates tends to be very tiny. It's only about 4%. And that's probably why we cannot find any big effects in the total alpha of the fund. If we had access to the data from the German central bank for long-short funds, that's exactly the situation where we would expect to really find a difference between funds that choose to lend and don't lend, simply because there's going to be a much higher proportion of shares that are being shorted by those funds and probably held even though they have high short selling. So we then spend a lot of time in the paper trying to disentangle the difference between public information that everyone knows relative to something that is just known because we choose to participate in the equity lending market. And we do so by using this European disclosure regulation of large short selling positions. Okay, and we find that indeed active funds that lend reduce their positions relatively more or relatively faster prior to the disclosure. So they do seem to know something that the other non-lenders don't know. And they do seem to anticipate these large short disclosures and potentially front run the short sellers. So they might actually be finding or figuring some information before the short sellers do, and they start reducing their positions, which again is consistent with this Goldstein and Young paper that I told you that tries to tell us when investors complement the trading activity of others or whether they compete and substitute what each other does. So thank you so much. And that's it. Now hit me with as many questions as you can. And if you want to ask questions in Portuguese, more than fine too.
Can I ask one here?
Yes, of course.
Or a couple. So you're conditioning always on full exits, yeah? So it's not a underweighting, yeah?
No, we do. So for example, here in this slide in 4, 5, and 6, we are just looking at position changes without exits. So,
but the exits are more extreme, the effect.
Yes, they're definitely more extreme in them. And that's exactly what, so let me show maybe this here in the ones with the, oops, with just the, see, with the exits, the coefficients are like 0.5, 0.3, and just considering reductions without exiting, they are weaker, which is kind of what we would expect, right?
Okay. Okay. And when you're saying that actually so they are benefiting from lending, actually shares, but actually overall there's no benefit. So how do you reconcile?
Well, so hear me, essentially is, let me split the answer in two. So one, I mean, when we do these tests here, it's not that they are making money. They are avoiding losing even more, okay, by lending.
So in some sense, they were in wrong positions and they...
Exactly. And by lending, it allows them to get out of a crappy situation faster. But in this analysis here, these results are only significant for those stocks in the portfolio that were in the top quintile of short selling. So those are the ones that are really hated by the market. If we repeat this analysis just looking at all stocks, then we don't find anything. So it seems that all of these effects are really concentrated in the stocks with high short interest, which are probably the ones that the market, or at least that the short sellers believe have a lot of negative price information that hasn't been incorporated yet. Okay, and because most of the funds, and I think I have this here. So no, actually back. So look here that in terms of the assets under management of the funds, on average, we are only lending about 3.4%, okay? So it's not a big amount relative to the assets under management of the fund. Yeah?
Okay.
Alan, acho que estava no mudo.
Okay. Yes, before we move forward with the questions, I'd like to say that everyone is now allowed to ask questions directly. So I know Rafael and Walter wants to ask questions. So move forward I think now we are under control, and then all mics are clear to go.
Thank you, everyone.
Bernardo also has questions. Please feel free.
Okay, so about the funds that decide not to lend, are they prevented from lending by any regulation or by law?
No.
They just receive the opportunity to acquire info.
Yeah. So no, they're not, and I think that ties to one of the questions that Rui wrote here in the chat. So lending stock is definitely not an exogenous decision, right?
Marcelo Fernandez using my account.
Okay. So essentially, I mean, this is definitely not exogenous, right? This will, as usual, vary with supply and demand. Okay, so if I see, for instance, that the demand for shorting a stock is very high, people are probably going to offer me a bigger fee, and that might make me lend it in the first place. Some stocks also have much more supply available than others. I mean, usually many small cap stocks, they might not be held as widely, and often it's difficult to locate them to borrow in the first place. Okay, but yeah, at least in Germany, and to be fair, I mean, in the US nowadays, the SEC has a regulation that prevents ETFs from lending more than 30% of their portfolio. So definitely there are some regulatory barriers that prevent some funds from lending a lot, but everyone can lend, okay? At least they can lend a little bit.
Thank you.
I have a question too. Oh, but Walter, I think Walter was before.
No, go ahead. No, I can wait. No.
Okay, yeah, that's fine. Yeah, I forgot that. So I have a question about the dynamics of what is going on. Because you have monthly data, so it seems that so people have this lending information, and then it takes a while in order for them to do something, but you still identify results, you still detect some results, right? Even though it's monthly. Now, it's very difficult to find a positive alpha for active portfolios, for active funds instead of passive funds. So once you control for the factors. Now, what happens in your data sets? So the active portfolios usually have higher alphas in your data sets. And
So,
can you see if the active portfolios that have this strategy, that even when they do that, they are different from the other active portfolios? So it's just to...
so okay, yeah, I didn't put it here. I think I have it. So just like everywhere else in the world, I mean, the net alpha after fees of those funds is essentially zero. Okay, in fact, it's even a little bit negative. Okay, notice that in the US, when we do stuff with portfolio holdings, the best we can get is quarterly data. That's kind of what we have in the 13Fs and so on. So in our case, we benefit a little bit because we have monthly information on their holdings. Okay, and even though we don't know exactly the point within a month that these funds decide to exit or not, this is one of those situations that it actually works against us finding anything, right? If this is really a quick short run effect and prices settle down, we wouldn't find any changes in the alpha at the stock level. In the paper, I didn't show you any tables on this, and we don't have much actually looking at a difference in the alpha at the fund level. Yeah. I'm not saying here that we have, and we would have loved to find this out, right? To say that on average, funds that lend have a slightly higher alpha than those that don't lend. And there are a couple of other papers that show, well, one of the reasons why this alpha can be higher is simply because, well, if you lend, you get a fee. So all else equal, you get a little bit more income in your fund relative to those that don't lend. Okay? But we don't find anything. The results we find is they do generate alpha in that relatively small subset of stocks that were being highly shorted. There we can identify that these funds, they generate some alpha. Or as I was telling you in response to Rui's question before, they are smarter to get out relative to those that lend. Okay?
Okay.
Walter, your turn.
Okay. Very intriguing paper. Congratulations. I think I understood the regressions. I'm not sure that this saturated fixed effect is very convincing given the potential for endogeneity, but I got the point. What I am struggling is to understand how the information flow carries on. And let me start with the potential noise. When you see someone borrowing, it can be information driven or some hedging activity. So might not be any private information. It's just that you are hedging. It's your portfolio decision. Involves some short sell. So whoever is taking the other side doesn't know for sure, I guess. No, I think that's the standard assumption. If there is some information in the flow or not. Now let's take the other side. There is this issue of whether the fund lands or not. But I will give this for you. Okay. There is some decision there, and we don't know very well why some funds do not land, but let's take the results as conditional on the fund being among the set that lands for the borrowers. I wonder if the assignment of the borrower is randomly set, how what is the mechanism that you have in mind that the lender will go through when it sees an order to get or request for lending? They will say, oh, am I just a random choice? If that's the case, I don't even know whether that the total demand is very big or not. It will look at the previous variables that you have in your regression for the total demand. And then there will be some process, I guess, of investigation, and then we'll start asking people in the market what's going on. I got a request for lending. What is going on? That's what came to my mind. And if that's the story, I guess there are other signals in the market pointing to in the same way, because someone who did not lend or did not get the request for lending will see some prices going down, or will see that there is an order because he has a friend, an order to sell, and then it comes to my concern with your regression. Is it really the dummy variables that you have, or is that you are not taking into account some unobservable variable for the econometrician that captures this trend for the stock?
Okay, so totally agree. So
that's my...
Okay, so let me try to reply then in 4 different steps. So the first one, I totally agree. I'm not saying that like our overkill of fixed effects will solve endogeneity. That's why we have the disclosure. But I agree with you that no all short selling is made with the purpose of speculating the price will go down, right? I mean, we have long short strategies that they can just be hedging. But what we do know from the literature is that usually, regardless of whether short selling of a stock is high, for hedging or speculative purposes, in the future, they tend to underperform. And that's the blue line in here, okay? And then, I mean, suppose that you are actually an owner, suppose that everyone is shorting Petrobras, okay? But suppose that I actually own Petrobras in my portfolio. So I can observe this public increase in shorting demand, okay? Like everyone else, regardless of whether we lend it or not, which is kind of part of the other signals that all of us have access to. But suppose that then I am actually lending this. Here I have 3 options as an investor. Knowing this result that short selling stocks underperform, I can do 3 things. I can say, well, something bad is going to happen and totally get out of the stock. I can try to maybe use this as a negative signal to change my beliefs and just lower the position. So I reduce my exposure, but not completely. But a third possibility could actually be what? I can say, well, screw it. Even though the market is shorting this stock, I like it. So now I'm actually going to lend shares to these investors and at least capture what? A little bit of the higher fees that will come with this higher demand, okay? So from the institutional point of view, I mean, what happens is that often a mutual fund that lends, they will never lend this directly. So think about Brazil. Actually, one of the largest custodians in the world is BNY Mellon, right? So suppose that we have a fund that would use BNY Mellon as the custodian. So what actually happens is that BNY Mellon would then gather all the stocks from all different funds and clients that they have, and then they will make those shares belong to the same pool that is then what? Potentially lent out to the short sellers. And unfortunately, I mean, we have no idea about how one lender is chosen relative to the others. In some of my previous papers, we have some measures, say, of how like the Herfindahl index on the demand side and the supply side, and we try to see whether we can do something in terms of how this affects the demand. But unfortunately, we have no idea about what makes Fund A be chosen by the lending agent to lend its shares relative to Fund B. Okay, and I agree with you. I mean, this might be definitely a non-random process that because this information could happen, but because of the over-the-counter nature of this whole securities lending market, usually what happens is if there's a stock that is highly in demand, the lending agent, so BNY Mellon, is going to start calling clients and say, well, do you have shares in Petrobras to lend? I mean, I don't see it in the pool, but maybe I can convince you to put them back in the pool if the fee is high enough. So in the regressions that we're trying to do in the paper, and I totally agree with you, I mean, we need to try to somehow control for the public signals and the public information that an econometrician would observe, and then try to somehow isolate whether there is something that being a lender gives to us. So that's why, I mean, we're trying to control one. On loan is the measure of the aggregate demand. So that's kind of the public signal that everyone observes. And we're just trying to then, through these interactions, to see whether condition on this public signal, whether we lend or not, will affect our behavior from the point of view of portfolio holdings. But as I mentioned, that's when the endogeneity concern will come, right? All of these regressions here, you might say, well, Pedro, that's kind of bullshit, right? Everything can be jointly determined. I mean, maybe both short sellers are selling and the mutual funds are reducing their positions because this company is bad. We have, I mean, it's being driven by something else in them. And that's why we use this, like the European disclosure, because, I mean, before the disclosure, we might observe a certain level of aggregate short selling. But now, because it's being disclosed to the market that there is a large investor betting a lot of money that this company will go down, as we know, I mean, usually if we have someone betting lots and lots of money, we often pay more attention to it, okay? So in a way, I mean, this is kind of like additional information that the market didn't know. So now we have some information about the identity of part of that aggregate short selling data that we all have. And then we test, given this disclosure that is unknown to the market, whether we observe some changes in the behavior from the active lenders before the disclosure, right? I mean, the lenders, they don't know that there is a large short seller from the aggregate short interest, but they might have some information because they are lending. So they can actually see whether their lending agents are calling them to see if I can lend even more shares and so on. And I totally agree with you. I mean, that's really the critical bit that we have to convince people in the paper, whether lending contains information that is not simply captured or subsumed by some omitted variable that we didn't have in the regressions, okay? This can be stock characteristics. So by having the stock time fixed effects, we can control for lots of this cross-sectional variation. We try to control for differences across funds, right? So maybe there is some weird behavior that my fund have if I decide to lend relative to those that don't. So we have a fund time fixed effect for that, trying to tease out as much of it as we can. Does that make sense to you, Walter?
I got the point. I think I would try to explore more this change in the rule. If this gives you some bite on the identification, I think you should give more space, at least in the presentations, but perhaps to start with. Because it was in the end, I'm not, this part I'm not sure that I got how it's helping your identification. It looks like a placebo, you're trying to say, or before it was not so important, after it was, but you know, the rule was passed for some reason, perhaps after it became
okay,
a bigger issue. I don't know.
So that was probably my mistake in not explaining well. So we're not doing like a diff and diff here. We're not comparing before and after this disclosure. My point is, after 2012, for every single stock that's traded in an exchange in the European Union, if there's a big short, you have to disclose it. So after 2012, so for all of our sample, every month we have an idea whether a particular stock has been targeted by a large short seller or not. So this is just like an event study, and we're trying to look at what were the position changes of the mutual funds before and after this disclosure of information. So the diff and diff is actually here in this sense, okay? So we try to compare what funds do before and after the disclosure, depending on whether they are lending or not, okay? And the idea is that this is an exogenous shock to the negative amount of information in the market, because we know that these large short sellers tend to forecast even more negative returns than just the information contained in the public aggregate short interest data. But
Yeah,
I totally
you
agree. In version 2.0, I promise that I'm going to do a better job.
Just quickly, I know that I'm taking too much time, but the argument you have just made, use the fact that you have some funds that lend and some funds that do not lend. It doesn't seem very convincing that this sharp line between the funds. But if you want to go in this direction, fine. But you don't get anything for free. You know that.
Mm-hmm.
And if you want to go in this direction, you have to make more effort on distinguishing the two funds. But thanks, it's, as I said, a very, very interesting paper.
Yes,
Okay.
indeed.
Cool.
We have time for final questions. I know André Lott asked and Bernardo Rica also asked a question. So if anyone, or if one of you two could ask the final question, feel free. Okay, perfect, André.
Thank you, André. I read here on the chat that you're going to send me the email. Thank you.
Yeah.
Comments are more than welcome.
Sure. So we have space. So for our final question, we are okay. So with no further question, I'd like to thank Pedro very much for his talk. Today we have some initial issues, but now during the course, I think we managed to have a great presentation. Thank you again for your time. You are willing always to help us. Thank you very much.
Thank you. Obrigado, André, como sempre a mim. É um prazer ver tantos amigos. Espero que vocês já não estejam de saco cheio de ver meus papers sobre short selling. E, bom, espero que todo mundo esteja bem aí, que safe and alert, como dizem aqui na Inglaterra. Obrigado mais uma vez. E, bom, qualquer e-mail, qualquer comentário, por favor, me mandem. Um abraço a todos.
Valeu, gente. Tchau,
Tchau, tchau, pessoal.
Obrigado. E nos vemos em 15 dias no seminário do Felipe.
Sim.
Já tá no site, tá bom? We will see again in 15 days. We have the next seminar with Felipe Aichan, which is in our website. Thank you very much.
Tchau, tchau.
Bye, bye.